So today, on the deep dive, our mission is to figure out how an entire nation managed to, well, basically break the fundamental laws of economics.
Yeah, completely shatter them.
Right. And we're going to look at what happens when the physics of finance finally catch up with them. We are pulling apart a milestone 2012 academic paper about Japan's sovereign debt.
Which is just a fascinating piece of research.
It really is. And I have to tell you right up front, if you think you understand how national debt works, the data in this research is going to completely upend your perspective.
Oh, absolutely. It's a total paradigm shift.
I mean, we are taught very simple rules about money, right?
Yeah.
That you're taught that if a country borrows too much money, it crashes.
Exactly. The global markets punish them.
Right. Borrowing costs skyrocket and the game just ends. But today, we are looking at a scenario where a country floats in midair. They are literally ignoring every rule of finance.
It is the ultimate rebellion against economic gravity. I mean, many people think that if a country borrows more than double its entire economic output, it should just instantly collapse.
Yeah, that's the common sense rule.
But the terrifying part is that Japan's debt skyrocketed to astronomical levels, and their borrowing costs didn't go up.
Wait, they didn't?
No, they went down. They hit rock bottom.
See, that's just a total face slap to common sense. My brain actively rejects that math. It's like jumping out of an airplane, pulling an anvil out of your backpack instead of a parachute, and somehow floating upward.
That is a perfect analogy. And to see the invisible wires holding up this whole illusion, we have to look at this milestone warning from two world-class scholars.
Right, the authors of the paper we're looking at today.
Exactly. Takeo Hoshi and Takatoshi, they published this working paper for the National Bureau of Economic Research.
And the timing here is super important, right? This was 2012.
2012, yes. While the rest of the world was totally panicking over the European debt crisis, staring at Greece and Italy.
Right, the Eurozone was basically on fire.
Yeah, but these two scholars, they built this massive data model proving something far scarier. They showed that Japan's anti-gravity trick was not some economic miracle.
It was a ticking time bomb.
Exactly, a ticking time bomb. And the countdown had already started.
So let's really set the stage for why this is so weird. Because history is a very cruel mirror here. If you look at the data from the G7 nations back then, most countries' total debt was in a relatively safe zone.
Right, hovering around normal levels.
But then you have Greece and Italy, and their debt sparks massive global panic. Interest rates go crazy.
Because that is the textbook reality. When you get close to that red line, investors demand massive interest rates to compensate for the risk.
But then you look at the chart for Japan, and the data from the paper shows their debt was drastically higher than those European countries.
Unbelievably higher. A towering red line on the chart.
Over 200% of their GDP.
Yeah.
But their 10-year interest rate, it stayed frozen below 2%.
Sometimes dropping under 1%.
Which just, I mean, how? This is not the calm of a prosperous nation.
No, not at all. The authors make it clear. This is the dead silence of the ocean pulling back right before a massive tsunami hits.
Okay, so here is where my brain completely breaks. Why does borrowing more money make the interest cheaper?
Well, traditional economic logic completely fails here. It just doesn't apply.
Because if maxing out my credit cards lowered my interest rate, I would be a billionaire by next week.
We all would be. But for 2 decades, the price of Japan's debt moved in the exact opposite direction of common sense.
But there is no way a bubble floats forever without someone propping it up, who is secretly paying for this.
To solve that mystery, the research says we first have to look at the real cards Japan was holding. The government was basically playing a massive accounting game.
Right, trying to hide the true scale of the problem.
Exactly. Forget the polite numbers they reported to the public. The authors say you have to use the strictest global accounting rules.
The national income accounting definition, right?
Yes. And when you use that strict definition, it captures everything. Local government debts, hidden bonds, all of it.
And what was the real number?
In 2009, their actual real debt was at an unbelievable 214% of GDP.
214%.
That is 1,023 trillion yen.
Wow. Over a quadrillion yen.
Right. The authors stress that this is no longer a simple budget deficit. This is a supermassive financial black hole. It literally cannot be managed.
So how do you prevent a 214% debt from just destroying your country overnight?
You lock the doors.
Wait, when you lock the doors?
You force your own people to buy it. You keep the foreign investors out.
Ah, okay. This is another face slap moment from the data. Japan didn't collapse because foreign sharks weren't the ones holding the debt.
Exactly. The paper shows that over 95% of this massive debt was swallowed up internally
By who, exactly?
by Japanese commercial banks, insurance companies, and ordinary citizens.
So it's basically a closed-door game of financial survival.
100%. As long as the domestic citizens keep buying, the illusion just continues.
But hold on, put yourself in the shoes of a bank manager in Tokyo. Why would a bank buy a bond that pays almost 0% interest? How do you make a profit?
You don't. But you buy them anyway because you are a psychological prisoner.
A psychological prisoner?
Yeah.
Explain that. How does a bank get trapped like that?
Well, the paper breaks down the mechanics. Japanese citizens are terrified of financial risk.
Because of the massive bubble burst in the 90s.
Right, the lost decade. So they hoard cash and standard bank deposits. They just want safety.
Okay, so the banks are flooded with cash.
But the banks are suffocating in a stagnant economy with deflation. There are no businesses wanting to borrow money to expand.
Because prices are dropping. Why build a factory today if you can't sell the goods for a profit tomorrow?
Exactly. So the banks have all this cash and nowhere to lend it. Add in the global banking rules, the Basel Accords.
Right, the international regulation.
These rules literally call government debt zero risk.
Zero risk weight, meaning the banks don't have to hold reserve capital to protect against it.
Yes. So the banks are literally forced by the environment and the regulations to gorge on these profitless government bonds. They have no choice.
Wow, so the math actually proves this.
Ironclad evidence. The paper cites a massive regression analysis from 2010 by a researcher named Tokuoka.
And what did that show?
It proves that Japan's high private savings rate is the absolute unquestionable king keeping interest rates crushed to the floor.
But the data model also tests what happens if that locked door opens even a crack, right?
Yes, and the results are terrifying. If foreign ownership increases by just 1 single percent,
Just 1%.
just 1%, the interest rate brutally spikes by 11 basis points.
That is massive in the bond market. So it's like a giant dam made entirely of domestic savings. If foreigners get involved, it's a crack in the dam.
And if the savings stop flowing, the entire valley floods instantly.
But gravity has patience.
Yeah.
It always wins eventually.
Always. There is a brutal physical ceiling to this magic trick.
A hard limit.
Right. The government can only borrow as much money as the private sector actually has.
Which makes sense. You can't borrow money that doesn't exist.
Exactly. The researchers calculated this absolute ceiling. It's the total net financial assets of the domestic private sector.
And what was that number?
In 2010, the maximum ceiling was 261.3% of GDP.
So even if Japanese citizens show psychopathic levels of patriotism they use every single penny to buy government debt. Once they hit 261.3%, the cash is gone.
It's totally gone, and when they run out of cash, the government must cross the ocean and beg foreigners for money.
And the foreign market is not going to accept 0% interest.
Never.
So what was pushing them toward this ceiling? What is the actual monster in the room here?
The true monster isn't a stock market crash. It is a slow, silent population meat grinder.
Aging.
Aging. It's the anthole in the dam. The paper details how the baby boomers are retiring.
And when you retire, your financial behavior completely flips.
Overnight.
Wow.
You transform from someone saving money to someone burning through their savings.
Stop adding water to the pool and you start draining it.
Exactly. The data here is so stark. In 2010, the national savings rate was sitting at around 3%.
Which gave them a little bit of breathing room.
Barely. Because the model predicted it would plunge below 2% by 2017.
And then?
And turn completely terrifyingly negative by the 2040s.
Negative, meaning the whole country is pulling money out faster than they are putting it in.
Yes. Money is vanishing. The ceiling is physically lowering every single day.
Now, I can hear politicians right now looking at this and saying, don't worry, economic growth will save us.
Oh, the golden decade prophecy.
Right. Let's test their absolute most optimistic fantasy.
The researchers actually did this. They ran a simulation where Japan grows by a perfect 2% every year for 40 years.
Which is incredibly optimistic.
A total fantasy. But even in this perfect fantasy, the model shows the debt violently smashing into the savings ceiling.
When? When do the lines cross?
By 2023.
2023. So the myth has an expiration date. From the time they wrote this study, they only had 10 years left.
10 years. Even if everything went perfectly.
Okay, but what about the tech guys? Silicon Valley enthusiasts will always say, technology and AI will create a productivity miracle. We'll just produce our way out of the debt.
The data mercilessly crushes this dream too.
How? Why can't tech save them?
Because the working population is shrinking so fast, the authors did the math. To maintain 2% growth with a shrinking workforce, you need a supernatural jump in worker productivity.
How big of a jump?
3.5% every single year.
Has that ever happened?
Japan hasn't seen those numbers since the neon-soaked 1980s. It is impossible.
So the productivity miracle is a complete illusion.
A total illusion. So the researchers said, forget the optimistic fantasies. Let's look at the cold, hard reality of a 1.05% historical productivity rate.
The death knell of reality.
Right. Under these realistic conditions, the government literally runs out of domestic money to borrow.
And when is the absolute deadline under the realistic model?
2024.
Wait, really? So when they hit that wall in 2024, they have to run out into the global market entirely naked. They have to pay whatever exorbitant interest rates global sharks demand.
That is exactly what the physics of the model dictate.
But, you know, destiny rarely gives you the exact amount of time scholars predict. It usually gives you less.
It always gives you less. And the paper factors in a massive real-world shock.
2011, the earthquake and the tsunami.
And the Fukushima nuclear disaster. These weren't just human tragedies, they were financial meteors.
The cost was staggering.
It created a 30 trillion yen black hole just for cleanup and compensation.
30 trillion yen. So the government is forced to issue massive emergency bonds.
Right, which violently dragged the doomsday timeline closer, the ceiling lowered, and the floor shot up.
So with this timeline shrinking rapidly, why weren't the global alarms sounding? We are taught that rating agencies act as the alarms.
The boy who cried wolf.
Right. If Moody's or S&P downgrades a country, its economy is supposed to implode.
Here is another massive blow to your common sense. The researchers looked at the actual history of downgrades in Japan.
And what happened?
Well, Moody's and S&P downgraded Japan repeatedly. In 2002, Moody's downgraded them 2 full notches.
2 notches. That should cause absolute panic. Capital flight. Currency collapse.
The result, the market didn't blink, interest rates actually went down.
Down.
Yes.
That makes zero sense. Why?
Because of the locked room. Foreign rating agencies have zero power to trigger a crisis when 95% of the debt is held by domestic banks, who are forced by their own regulations to keep buying it.
Oh, wow. So they are just shouting at a brick wall.
Exactly. The rating agencies are completely useless here.
So if downgrades don't matter, what is the actual trigger for the apocalypse?
To find that out, the authors say you have to look closely at the hidden shadows of the financial market.
The shadow metrics.
Look at the cost of bond insurance, credit default swaps, or CDS spreads.
Basically, fire insurance on the debt.
Right. While the interest rates looked calm, the cost of that fire insurance silently doubled.
So the smart money knew the house was full of oily rags.
They absolutely knew. But the real fuse, the actual trigger that will blow the whole thing up is political.
Political. How so?
The whole system is running on the psychological hope that the adults in the room will eventually fix the math.
By raising taxes.
Yes. So what happens if a tax increase bill fails in government? What if politicians just refuse to do it?
Or what if imported inflation forces the central bank to raise rates?
Exactly. If either of those things happen, the market's hope dies.
And panic selling vaporizes the system in a matter of days.
Days! The illusion just shatters.
Okay, so is there any escape route left? Can they fix this?
Yes, but the mathematical price of saving the country is historically brutal.
What is the solution?
The only equation that works is massive, crushing taxation.
The paper runs the numbers on this, right?
They do, and the face slap here is awful.
Well,
To survive, the total tax burden must skyrocket from around 30% to 46%.
46%. That's almost half the economy.
And that is the optimistic scenario. If interest rates tick up even slightly, taxes must hit 50%.
Half of everything earned, just gone.
Handed to the state. It touches the absolute red line of human tolerance for taxation.
But what if politicians do what politicians do best?
You mean procrastination?
Yeah. What if they just delay the tax hikes by, like, a measly 5 years to win an election?
The punishment is absolute hell. The paper specifically models the cost of delay.
And what does a 5-year delay do?
It pushes the debt curve into a vertical spike. It instantly shatters the savings ceiling.
It's like ignoring a cancer diagnosis for 5 years because you want to enjoy your vacation.
Yeah.
By the time you get back, it's terminal. Short-term votes guarantee a long-term abyss.
That is exactly what the math shows.
Okay, so let's imagine the crisis hits tomorrow. The ceiling breaks. How fast do the dominoes fall?
The carnage is immediate. If the interest rate rises by just 1%.
Just 100 basis points.
Right. Japanese banks instantly suffer a 4.7 trillion yen loss on the bonds they are holding,
4.7 trillion yen wiped out instantly.
which wipes out nearly 12% of their core capital, their Tier 1 capital.
So the banking system is completely paralyzed.
Paralyzed. And to save the banks, the central bank will cross the ultimate red line.
Debt monetization.
Yes. They will aggressively print massive amounts of money out of thin air to buy the worthless debt.
Which instantly ignites hyperinflation.
And the currency falls off a cliff.
This leads us to the ultimate interrogation of history that this paper brings up. Wealth does not just evaporate into the air.
No, it is violently transferred.
Hyperinflation is a weapon.
It is. It will ruthlessly transfer wealth from the elderly, whose life savings become completely worthless.
To the young, whose debts are inflated away.
Exactly. It's a brutal societal reset.
Japan built a 30-year myth defying the laws of gravity, but demographics and math are undefeated.
You cannot rewrite the laws of physics.
So to you, the listener, I want to leave you with a final provocative thought. Look closely at the world today. Look at the other aging, debt-addicted superpowers around the globe right now.
There are quite a few of them.
Are you absolutely sure your own country isn't following this exact same blueprint? Think about where your savings are sitting today, because gravity always wins.